All right, everyone, welcome back to another critical edition of Updates with John. Over the last few weeks, we've been observing a phenomenon in the global silver market that demands our immediate attention. The demand for silver, specifically flowing through the major exchanges in Shanghai, the Shanghai Futures Exchange, and the Shanghai Gold Exchange, has not just been increasing, it has been surging with an undeniable force. This isn't a gentle rise or a slow, steady trickle. It's a persistent, powerful surge that shows no signs of abating. And here's the part that should make every serious observer of the silver market sit up and take notice. While Shanghai continues its relentless pull of physical metal eastward, the COMEX, which serves as the primary silver futures exchange here in the United States, is once again witnessing a significant contraction in its registered inventories. Just when some might have thought the pressure was easing, it has returned with renewed intensity. The drawdowns are back, and the timing of this renewed pressure offers profound insights into the underlying realities of what's truly transpiring beneath the surface of the market. This isn't mere speculation, nor is it some fringe theory concocted in the dark corners of the internet. The hard data is readily available, laid bare in the official exchange reports. We're seeing consistently elevated premiums for silver in Shanghai compared to the London spot price. Concurrently, COMEX registered silver stocks have been on a clear downward trajectory, and the physical flow of this precious metal continues its unwavering movement in one singular direction: east. For those of you who have been following the silver market for years, you understand that inventory levels are not just abstract figures. They are not merely numbers on a spreadsheet. These figures represent the actual, tangible, physical metal that underpins the vast volume of paper contracts traded every single day. When these inventories begin to thin out, the entire structural integrity of the futures market undergoes a fundamental shift. The margin for error, the buffer that typically absorbs market fluctuations, begins to disappear. And with that disappearance, the potential for a genuine, undeniable supply crunch becomes not just a possibility, but a very real and imminent threat. Today, we are going to meticulously dissect exactly what is unfolding. We'll explore why Shanghai's demand continues its upward climb, what specific factors are fueling this insatiable appetite, how this directly correlates with the mounting pressure on COMEX inventories, and, most importantly, what these developments signify for the future trajectory of the silver market. So stay with me on this journey, because the picture that is currently forming is one that could very well define silver's path for the remainder of this year and well into the future. Let's begin our deep dive with Shanghai, as this is truly where the heart of the current story lies. For many years now, China has held the undisputed title of the single largest consumer of industrial silver on the planet. This fact in itself is not new information to seasoned market watchers. However, what has emerged as a significant development, or at least what has intensified dramatically in recent months, is the sheer scale and the unwavering consistency of the demand for silver flowing through Shanghai's prominent exchanges. The Shanghai Futures Exchange, which is responsible for facilitating the vast majority of China's silver futures trading, has consistently reported elevated trading volumes. The open interest, which represents the total number of outstanding derivative contracts that have not been settled, has been steadily climbing. More critically, the physical delivery numbers, the actual amount of silver taken off the exchange, have remained exceptionally robust. When traders on the Shanghai Futures Exchange opt to take physical delivery of silver, rather than simply rolling over their contracts or settling in cash, this is not indicative of speculative behavior. This is a clear, unambiguous signal of genuine, tangible demand for real, physical metal. Furthermore, we have the Shanghai Gold Exchange, which, despite its name, plays an incredibly vital role as one of the most significant physical silver markets globally. The withdrawal figures from this exchange, representing the quantity of silver physically removed from its vaults, have been consistently high, month after month. These sustained withdrawals signify that metal is not merely changing hands on paper, it is physically exiting the exchange system entirely. This silver is then directed into the hands of industrial end users, fabricators who transform it into components, and strategic national reserves. And once it leaves these vaults and enters the Chinese industrial complex, it does not, as a general rule, easily find its way back into the global market. So, the crucial question arises: what is driving this unprecedented surge in demand from China? The answer lies in a confluence of several powerful drivers operating simultaneously. Firstly, and perhaps most prominently, we have China's burgeoning solar photovoltaic industry. This is not a minor contributing factor. It is, arguably, the single most significant demand story unfolding in the silver market today. China's dominance in global solar panel manufacturing is absolute, accounting for approximately 80% of the world's total solar cell production. And every single one of these solar cells, without exception, requires silver paste, a conductive material derived from silver that is absolutely essential for the cell's ability to efficiently convert sunlight into electrical energy. There is simply no viable substitute that can match silver's performance in this critical application. Moreover, the newer generations of solar cells, specifically the heterojunction and TOPCon technologies, which China has been aggressively scaling up throughout 2025 and continuing into 2026, utilize significantly more silver per cell compared to the older PERC technology they are progressively replacing. Some credible estimates suggest that these advanced, higher efficiency cells demand up to 30% more silver per watt of generating capacity. China has not been timid in its deployment of this cutting-edge technology. It has been scaling up production at a pace and magnitude that truly staggers the imagination. Consider this for a moment. The world's largest consumer of silver is not only adopting a technology that inherently requires more silver per unit, but it is simultaneously accelerating the production scale of these units. This isn't a linear increase in demand. This represents an exponential pressure being exerted on the already constrained global supply of silver. Secondly, China's massive electronics manufacturing sector and its ambitious 5G infrastructure build-out continue to absorb substantial quantities of silver. Silver's role in modern electronics is not merely preferential, it is indispensable. It holds the unique distinction of being the most electrically conductive element on the periodic table. There is simply no other substitute that can reliably match its unparalleled performance in high-reliability applications. Think about it. Every smartphone you use, every 5G base station that enables lightning-fast connectivity, every electric vehicle control unit that powers the next generation of transportation, silver is an integral component within these devices, performing critical functions that no other metal can execute with comparable efficiency. Thirdly, and this is a factor that often receives insufficient attention, there appears to be a discernible pattern of strategic stockpile behavior. This isn't just coming from private industrial buyers. Strong signals suggest that state-adjacent entities within China have been actively accumulating silver. The observed pattern bears a striking resemblance to what we have witnessed with other strategically important commodities. When the Chinese government or its affiliated entities determine that a particular material is critical to its long-term industrial future and national security, they embark on a quiet, consistent, and sustained program of reserve building, and they typically do not cease this accumulation until they have established a comfortable buffer. Given silver's undeniable importance to the rapidly expanding solar energy sector, its foundational role in advanced electronics, and its applications in various military technologies, it should come as no surprise that Chinese policymakers have clearly designated silver as a strategic industrial metal. The practical consequence of this designation is that Shanghai's demand for silver is not merely cyclical, subject to the whims of economic cycles. Instead, it possesses a structural floor beneath it, a baseline demand that continues to rise steadily, irrespective of short-term market fluctuations. Now, this is where the data becomes truly compelling, and it's the aspect that most mainstream financial media outlets consistently overlook. For extended periods throughout 2025, the price of silver in Shanghai has consistently traded at a premium compared to the London spot price. What does this mean in plain, understandable terms? It signifies that buyers in Shanghai are willing to pay a higher price for silver than the established global benchmark price, which is traditionally set in London. This persistent premium is, in essence, a flashing neon sign, broadcasting a clear message to the global market. We need more metal, and we need it now. In a perfectly balanced and efficient market, such a significant premium should not exist. Metal should flow freely, supply should readily meet demand, and prices should align seamlessly across all global exchanges. However, when a persistent and substantial premium emerges in one specific location, it serves as an undeniable indicator that the market is far from balanced. It signals that demand in that particular region is dramatically outstripping the available local supply, and this premium then acts as a powerful magnet, drawing physical metal from other parts of the world towards the area that is willing to pay the most. This Shanghai premium has been functioning precisely as such a magnet. It provides a compelling financial incentive for traders and refiners to direct physical silver shipments towards China, rather than delivering it to traditional hubs like London or New York. Every single ounce of silver that flows eastward in pursuit of this premium is an ounce that becomes unavailable to satisfy demand in Western markets. And this premium has been far from trivial. At various junctures, it has been substantial enough to render the economics of shipping metal from vaults in London or Switzerland to Shanghai exceptionally attractive, even after meticulously factoring in all associated costs, including transportation, insurance, and the expenses of refining. When the arbitrage window is this wide open and persistent, physical metal moves with remarkable speed and efficiency. The critical question that then arises is, Why does this premium continue to persist? If metal is indeed flowing eastward to close the gap between supply and demand, why does the market not normalize? The answer, though straightforward, is somewhat unsettling. The underlying demand in Shanghai is growing at a pace that far outstrips the ability of global supply to respond. It is akin to attempting to fill a bathtub while someone continuously widens the faucet. Water is flowing in, but the tub's capacity for more seems endless. There is also a significant structural issue at play here. China's domestic silver mine production, despite its considerable scale, has simply not kept pace with the explosive growth in its industrial demand. While China is, in fact, one of the world's larger mine producers of silver, the demand side of the equation has simply outpaced its domestic output. This widening gap must, therefore, be filled by imports, and these imports inevitably draw from the same finite global pool of silver that every other nation and industry relies upon. This brings us directly to the critical pressure point that holds immense significance for Western silver investors, the COMEX. The COMEX, which is the commodity exchange division of the CME Group, stands as the central hub for precious metals futures trading within the United States. When you hear a financial commentator or a news report quote the price of silver in America, that figure is almost invariably derived from the trading activity of COMEX futures contracts. However, there is a fundamental aspect of COMEX that many casual observers fail to fully grasp. The futures contracts that trade on COMEX are theoretically supposed to be backed by physical silver that is securely held in approved vaults. This physical silver is categorized into two distinct types. First, there is eligible silver, which refers to metal that meets all the exchange's stringent specifications and is stored in approved vaults, but has not yet been specifically earmarked for delivery against a contract. Second, and more critically, there is registered silver. This is metal that has been specifically warranted and made available for immediate delivery against outstanding futures contracts. The registered silver figure is the truly critical number, as it represents the actual physical metal that stands behind the paper promises of the futures market. And that number, as we have been observing, has been under considerable and sustained pressure. Throughout the first half of 2025, COMEX registered silver inventories have been in a clear state of decline. While markets rarely move in perfectly straight lines, the overarching trend has been unmistakably downward, characterized by a series of drawdowns. Metal has been consistently leaving the registered category, either through reclassification back to eligible status, or, more significantly, through physical withdrawal from the vaults entirely. According to recent reports, the total silver inventories at COMEX have been hovering around levels that, while not at their absolute historical lows, represent a very substantial reduction from where they stood just a couple of years ago. The registered portion, the metal that is genuinely available for physical delivery, has been particularly tight. Now let me provide some essential perspective on this situation. The COMEX silver futures market facilitates the trading of an enormous volume of contracts every single day. The notional value of silver that changes hands on paper through these contracts utterly dwarfs the actual amount of physical metal that is sitting in the vaults. Estimates have consistently suggested that the ratio of paper silver traded to physical silver available for delivery has reached extraordinarily high levels. Some astute analysts have even placed this ratio north of 300 to 1 on days of peak trading volume. This seemingly unsustainable ratio only functions effectively as long as the vast majority of contract holders are content to simply roll their positions forward or settle their contracts in cash, rather than exercising their right to demand physical delivery. The entire intricate system of the futures market is predicated upon this fundamental assumption, that most participants do not actually desire the physical metal itself. They are primarily seeking exposure to its price movements. However, when genuine physical demand, particularly from powerful centers like Shanghai, begins to systematically pull metal out of the global system, and COMEX inventories consequently decline, that foundational assumption starts to appear increasingly fragile. It is not yet broken, but it is certainly showing significant signs of strain. The renewed pressure on COMEX inventories observed in mid-2025 is directly and inextricably linked to the events unfolding in Asia. When the Shanghai premium acts as a powerful magnet, drawing physical metal eastward, that metal frequently originates from the broader pool of globally available silver. This pool includes metal stored in COMEX-approved vaults, in the vaults of the London Bullion Market Association, LBMA, and in various private storage facilities around the world. It is crucial to understand that all these segments of the global silver market are interconnected. When one major demand center begins to vacuum up supply with such intensity, every other center inevitably feels the ripple effects. Most people tend to perceive silver merely as a ticker symbol, a fluctuating number on a screen. But beneath that digital representation lies a profound physical reality that ultimately governs every aspect of its market. Real bars of silver, typically weighing 1,000 ounces each, must be physically stored, transported, refined, and ultimately delivered. And the complex logistics involved in moving this metal across the globe are far more intricate and significantly more important than most investors truly comprehend. Let's delve into the typical flow of silver when demand from Shanghai is particularly robust. Silver is primarily extracted from mines located in countries such as Mexico, Peru, China itself, Australia, Poland, and Chile, among others. Once this raw silver is refined into exchange-grade bars, it then enters the global market through established hubs like London, Zurich, and New York. Historically, London has served as the undisputed center of the physical silver market, with the London Bullion Market Association, LBMA, playing a crucial role in overseeing the standards and settlement procedures for physical trades. When demand from Shanghai surges and the premium for physical silver opens up, traders and banks that hold silver in London or New York are presented with a clear economic choice. They can either retain the metal in its current location, incurring ongoing storage costs, or they can sell it into the Shanghai market at a premium, thereby capturing the significant price difference. For large, sophisticated trading houses, this represents a straightforward arbitrage opportunity. They proceed to ship the metal eastward. However, there is an important nuance to this process. The delivery specifications of the Shanghai exchanges sometimes differ from those of COMEX or LBMA standards. Chinese exchanges often prefer silver in specific bar sizes or with particular refiner marks. This means that a portion of the metal flowing to Shanghai must first pass through refineries, often located in Switzerland or even within China itself, to be recast into the appropriate form. This refining process takes time. It is not instantaneous. And during this period of transit and refining, the silver is effectively removed from the readily available Western supply. Therefore, when you observe a decline in COMEX inventories, a significant part of what you are witnessing is this physical flow in action. Metal is being systematically pulled from New York vaults, transported, sometimes via London, sometimes through Swiss refineries, and ultimately making its way to Shanghai. The physical form of the bars might undergo changes along this journey, but the underlying ounces of silver remain the same. And once these ounces arrive in China, they very rarely, if ever, return to the global market. This unidirectional flow is one of the most critical dynamics shaping the silver market today. China is, unequivocally, a net importer of silver. The metal enters the country and is rapidly consumed by its vast industrial complex. Solar panels are installed on countless rooftops and in massive solar farms. Electronics are assembled on sprawling production lines. The silver is utilized. It does not simply sit idly in a vault, awaiting re-export. It becomes an integral, consumed part of the physical economy. Contrast this with the silver that resides in COMEX vaults. This metal is ostensibly financial silver, held as a crucial backstop for the futures market. However, when the physical market experiences such intense tightening, even this financial silver is inevitably drawn into the real economy. This is the fundamental tension at the core of our story. Financial silver and industrial silver are both drawing from the same finite global pool. And right now, the industrial side, spearheaded by the relentless demand from Shanghai, is clearly winning this tug of war. Now, whenever demand experiences a significant surge in any commodity market, the natural and immediate question that arises is, why doesn't supply simply increase to match it? With silver, the answer to this question unveils one of the most consistently underappreciated facts about this particular metal. Silver is not primarily extracted from the earth as a standalone product from dedicated silver mines. In fact, a substantial majority, roughly 70% to 75%, of all mined silver comes into existence as a byproduct of mining other, more primary metals, such as copper, lead, zinc, and gold. This fundamental characteristic means that the overall supply of silver is largely dictated by the economic viability and production decisions pertaining to these other metals, rather than being solely influenced by the price of silver itself. For instance, if copper miners decide to reduce their production output because prevailing copper prices are insufficient to cover their operational costs, then, as an unavoidable consequence, silver output will also decline, irrespective of what silver's price might be doing in the market. Similarly, if a major lead-zinc mine in a country like Peru faces significant operational challenges or disruptions, the global silver supply will inevitably take a hit. The silver market, therefore, possesses very little inherent ability to independently and rapidly ramp up its production in direct response to its own demand signals. Primary silver mines, those operations whose main economic purpose is the extraction of silver, account for a relatively small fraction of the total global supply. Furthermore, bringing new primary silver mines online is a process that is measured in years, not mere months. This arduous undertaking involves extensive exploration, navigating complex permitting and regulatory frameworks, conducting thorough environmental reviews, securing substantial financing, undertaking massive construction projects, and finally, commissioning the entire operation. A new silver mine that might be discovered today could realistically take anywhere from 7 to 10 years before it produces its very first ounce of metal. Consequently, there is simply no effective short-term supply response mechanism within the silver mining industry. The Silver Institute, which is widely regarded as the authoritative source for comprehensive annual supply-demand data, has meticulously documented that the global silver market has been operating under a structural supply deficit for several consecutive years now. The combined total demand from industrial applications, investment buying, the jewelry sector, and silverware production has consistently exceeded the total supply derived from both mining operations and recycling efforts. This persistent deficit has had to be covered by drawing down existing above-ground stockpiles, essentially the silver that has already been mined in previous decades and is currently held in vaults, within exchange-traded funds, ETFs, and in various private holdings around the world. When you hear reports that COMEX inventories are declining, you are, in essence, witnessing these above-ground stockpiles being systematically drawn down to cover the ongoing deficit. The accumulated buffer, which once provided a cushion against supply shortfalls, is being consumed at an accelerating pace, driven by the surging demand from Shanghai. Recycling, which represents the other significant source of silver supply, has certainly seen some increases, but it too faces its own inherent limitations. The silver embedded within solar cells, for example, is notoriously difficult and economically unfeasible to recover. The amount of silver per individual solar panel is minuscule, making large-scale recovery efforts prohibitively expensive and inefficient. Moreover, solar panels are designed to have a lifespan of 25 to 30 years, meaning that the vast majority of silver contained within them will not become available for recycling for decades to come. The infrastructure required for efficient, end-of-life silver recovery from photovoltaic panels is either nascent or virtually non-existent in most markets globally. Similarly, silver used in various electronic components presents comparable challenges to recovery. A significant portion of the silver consumed industrially each year is, for all practical purposes, permanently removed from the recyclable supply chain. It becomes an integral part of a rooftop solar array in a province like Shandong, or a microchip in a smartphone, and from that point onward, it effectively ceases to be a part of the circulating, recoverable supply. This means that the arithmetic of the silver market in mid-2025 presents a stark and undeniable reality. We are confronted with a structural supply deficit that has been ongoing for several years, a deficit that is now compounded by steadily declining COMEX registered inventories. This situation is further amplified by a persistent Shanghai premium, which continues to exert a powerful pull, drawing physical metal eastward at a pace that refiners and global logistics networks are struggling to accommodate. And critically, there is no meaningful new mine supply anticipated to come online in the immediate future. These are not merely marginal pressures. They are interconnected forces that compound upon one another, creating a feedback loop of tightening supply. And yet, despite these profound underlying dynamics, the price of silver, as of this week, hovers around the $64 to $66 per ounce mark. This apparent disconnect between fundamental reality and market price is precisely what makes this moment so compelling and potentially transformative for those who understand its true implications. The quiet movement of silver bars across oceans is, in fact, a loud declaration of a new economic reality. And understanding this reality, before it becomes front-page news, is what truly sets apart the informed from the unprepared. The future of silver, and indeed a significant portion of global industry, hinges on how these converging forces ultimately resolve themselves. The stage is set for a dramatic revaluation, not just of silver, but of the very assumptions that have governed its market for decades. And we, here at Updates with John, will be here to break it all down for you, every step of the way. Stay tuned, because this story is far from over.